Hi and welcome back to another video. In this video we're going to be analysing Disney and all of its parts, as well as coming up with a fair valuation for Disney stock and an estimated investment return from buying Disney stock today. The Walt Disney Company, which is its formal name, is a worldwide entertainment company, and a huge one at that. It needs no introduction, and I bet you are all very familiar with it. The company operates in 4 business segments. We've got media networks, parks, experiences and products, studio entertainment, and direct to consumer and international. The media segment, which is the largest segment of the business, making up 40% of revenues, includes cable and broadcast television networks such as ABC, ESPN, FX, Hulu Original, Disney Channel, and National Geographic. This segment actually managed to grow 14% in 2020, which is great for such a large and established business. The studio entertainment segment, which makes up 13% of revenues, includes well-known studio production brands such as Marvel, Pixar, Walt Disney Studios, 20th Century, bought from Fox a couple of years back, and a few others as well. As you would expect, this segment's revenues declined 13% in 2020, with movie theatres and production being halted for most of the year. The parks, experiences and products segment includes various theme parks around the world, such as California, Florida, Paris, Shanghai, Tokyo, Hong Kong, to name a few. This segment also includes their cruise line and any Disney products that they sell in their brick and mortar retail stores. As you could imagine, this segment took the biggest hit during 2020 from the pandemic, with revenue falling 37%. However, it still makes up a large portion of the business at 23% of revenue. Last but definitely not least, the direct-to-consumer segment includes high-flying streaming services such as Disney+, ESPN+, and Hulu. This segment managed to prosper during the pandemic and grow to an impressive 24% of total revenues for Disney. The growth rate is fantastic at 81% year over year. This is mainly attributable to the successful launch of Disney+. The growth hasn't shown signs of slowing either, with the last quarter of 2020 showing 41% growth versus the year prior. Leading on from that, they recently announced that Disney Plus had reached 100 million subscribers in just 16 months after launching. And to give you an idea of how big that is, Netflix is at around 200 million, but with a much more established streaming service and much more time and investment into new content. Disney have said that they are so inspired by its success that they plan to be even more ambitious and significantly increase their investments in developing high-quality content for Disney+. Such significant investments can be seen in new launches such as Star, which is allowing for similar content as, say, Hulu, but for international subscribers, which allows them to compete with Netflix a lot better. Essentially now, your Disney Plus subscription, wherever you are in the world, gets you a lot more than before at a very cheap price. And of course, Disney has some very clear competitive advantages in this area of content creation and distribution, because they already own a vast number of characters, series, films, and intellectual property in general that they can monetize through streaming networks. And we see here how their ambitions have changed, mainly due to the fact they absolutely smashed their previous 2024 guidance for subscriber growth, reaching and in some cases exceeding their targets 4 years early. They've reassessed those estimates and upped them to 230 million subscribers in 2024 for Disney+, which is over double from here. And if we package all of the streaming services together, and that's ESPN+, Disney+, and Hulu, which are all expected to grow very quickly, Disney are giving guidance that they will have 300 to 350 million subscribers globally by 2024. And they believe the segment will be profitable by either 2023 or 2024, and they've given guidance for that. That means that their current average revenue per sub, the direct-to-consumer segment, could produce up to 56 billion of profitable revenue by 2024, from being less than $9 billion just 5 years prior. And if this video analysis is heavily focused on the direct-to-consumer or streaming segment of the business, it's because it should be. Disney are such an established brand, and all of its other segments are pretty much market leaders with highly durable moats. Their growth into the future will be somewhat predictable, but there are some big and obvious catalysts that will boost Disney's near-term year-over-year growth in some segments, such as the full reopening of various different economies and countries and an increase in travel and leisure. Disney have said they expect to open most of their parks and resorts by late April, and this is obviously not a certainty though. Disneyland Paris have already said they won't be reopening due to the situation for COVID in Europe. So this pretty much depends on the pandemic situation as we approach late April. Disney have also gone some major restructuring and rethinking really to their business model over the course of the pandemic, and I think they'll be a much better company and stronger force because of it. For example, firstly, the company has restructured its media and entertainment division and its expenditures, which is the biggest division in the company, to focus more on Disney Plus and the streaming opportunity. Disney announced plans for about 100 film and television projects, of which 80% will go directly to Disney Plus. That's a lot of content coming Disney Plus and Disney Plus subscribers' way. Secondly, they are closing 20% plus of their Disney Store retail brick and mortar retail locations, and that's just the start of it as well. These are just the first tranche of closings, if you can call it that, and they're setting their focuses on an e-commerce play and building out that part of the business, which I really think can prosper, especially if you think about it in the vein of buying gifts for kids and things like that. They never really built up an e-commerce presence to test that market demand or penetrate that market before. One example you could pick from is Nike. They went through a similar change, but a few years ago now, and now their sales are higher than ever before, and the company is prospering and looking good into the future because their e-commerce business is so large and effective. And as for Disney's stock, well, it's had a very good run up, especially in recent times, since the low it hit last year at the beginning of the pandemic, when it dipped to actually below $80 per share, which is unbelievable to think of now. And unbelievably, I actually picked up Disney around the late 80s mark because it was, a hard hit stock and a company that, in my opinion, wasn't going anywhere and would be back to business after the pandemic. And I thought it dropped so quickly. There was so much bad news around it. It seemed like a good choice to pick up for a value play. And I gave myself a price target, valued the stock, and once it hit that, I sold it. It was more of a value play, like I say, for me at the time than a long-term hold. But of course, looking at it now, I'm gutted that I ever sold it because I sold it around summertime or late summer in August, but realised, a nice 50% gain in a few months and moved the cash into another position that I thought was a better long-term opportunity and actually probably still do so. But now that's not to say that Disney isn't a great business with a great future, because it is. It was just my game plan at the time. But anyway, that's why you don't focus on selling and why I don't like to talk about selling too much, because if you find the right stock, you should focus on just buying and holding for as long as possible. But there's definitely a lesson to be learned there, and I want to be transparent with you guys about any mistakes that I've made. So Disney is now trading at all-time highs in respect of PE, but lifted this PE by the fact trailing 12 months earnings have taken a hit, but also all-time highs when measured on a price to sales metric too, which is probably a more constant metric to go by, considering that sales didn't drop as much. They pretty much stayed flat year over year. Of course, this is mainly due to the bullishness around the streaming services and its growth, but you always hear, is the good news or growth priced in already? Well, yes, obviously, growth is always priced in. The stock market's a forward-looking mechanism. The people in it are hungry and will pounce on anything, say the word growth, and they buy straight away, especially in a market like today's. Likely potential growth in a very well-known and documented company like Disney will not go unnoticed, and we can see that from the stock price surge recently. What we need to do is see if all of that has been priced in correctly and come up with our own fair value for Disney based off our estimates, and then calculate what sort of investment return would Disney give us from owning it over the next 5 years. And what I've done to forecast the next 5 years for Disney with a higher degree of accuracy is forecast the growth per business segment, then apply the likely earnings margins to that revenue, and then input it into our DCF model to get a valuation for Disney today. I don't know how easy you can see this, but it's just really a rough workings guide as to what the revenues will be up until 2025. So we've got firstly media networks, which makes up 40% of revenue, I'm saying that will grow at 10% per year into 2025. It's currently 15%, but I think this will slow slightly as the focus and strategy starts to lean towards streaming more than the legacy networks. Direct consumer, which is the big one, I've got it getting to 62 billion in revenue in 2025, which, when you actually account for the eliminations, which we'll get to in a moment, takes it to its target in terms of subscribers and average revenue per subscriber. So we're actually leaving some money on the table, saying that the revenue per subscriber doesn't grow, but they do reach that 300 mil estimate for subscribers in the direct consumer business. And that growth rate is 30%. Compound annual rate over the next 5 years, which would be pretty impressive if they can do it. Parks and experiences, I've got that growing at 10% in the first year, so we get a little jump next year, but then really 2022, and this is what some of the analysts think as well, we'll see quite a big jump in revenue. I've gone with 30%. Some are actually estimating higher, but I think we'll see a 30% jump, and it will get back to around that pre-COVID level, and then start to grow 10% on from there. The park experiences and products segment, remember, they're leaning more towards e-commerce on the products portion as well, which I don't think is going to be a game changer for Disney, but I definitely do think, one, it could improve margins, but also provide a little bit of growth in the products area of the business. The studio entertainment business, which is the smallest part of the business, I have growing at 10% in 2021, so we're going to see a little bit of a jump again in this segment, and then another 15% jump in 2022 as movie theaters and leisure starts to open again. A lot more production goes into making new movies and new series and things like that. And then I've got it growing at a steady 5% thereafter. And I think as more effort and more money and investments put into streaming and the streaming portion of the business, I do think the studio entertainment portion is going to see a little bit of drop off because of it. Now, it's not been growing at a bad rate, before that, but it's a fairly big business as well. I just wouldn't want to put a big growth rate on this when I don't exactly see how they're going to be able to grow it that drastically over the next 5 years. As you can see, they get to 154 billion of revenue in 2025 based off of all of these projections, which is basically a double in 4 or 5 years, which is good to see. And then I've got this here, which is the revenue less limitations. If I show you their annual report, I have something for eliminations. Now, I'm guessing this is for prepaid tickets for the parks and experiences and things like that. Maybe some stuff on the media networks as well that they weren't able to fulfill. So they have to obviously give that money back or refund that money. That jumped up to 10% of revenue in 2020 due to COVID. But before that, it seemed like it was a steady 2%, maybe 3% of revenue. Maybe even less than that. But we'll go with 2 to 3% in our estimates and be fairly conservative. And that just drops the revenue slightly, but we still get to around 150 billion by 2025. Now, the EBIT margins, I've gone with our profit margins prior to COVID. So the media network's very profitable at 30%. Direct consumer, not profitable yet, but they have plans for that to be profitable in 2023. Parks, products, and experiences, 25% before COVID, but I think that could get more profitable. I honestly do, with the move to e-commerce and some of the restructuring of the businesses that they've done, especially with the brick and mortar retail shops. Studio entertainment was profitable as well at 24%. So actually, they were a very profitable company, well-established profitable company before the COVID crisis. And I think if we just go on the safe side, we just go with those profit margins that we had previously, plus an assumption that the direct consumer business can at least get to a 20% profit margin by 2025. To give you an idea, Netflix's operating margin is at around 15% at the moment, and they're investing heavily in content, investing heavily for growth. I have some confidence they'll actually be able to get a better margin than 20%, but we'll play it safe for now. Keep it at 20%, and that gets us to 2025 operating profit of 37 billion, less the eliminations, and we get to 36 billion, which is a 25% margin overall for the company. And what that looks like in our base case scenario valuation for Disney, just pause it if you want to have a deeper look at the numbers. I'll just quickly scan through it. We have that revenue getting up to near 150 billion in 2025 on a 25% operating margin. That gets us to 37 billion of profit in 2025. Free cash flow is actually 55% of earnings, because that's sort of the pattern that they've had beforehand, although they had a blip in 2019 when they made that big acquisition, but CapEx is usually around 7 to 8% of revenue. Remember, with Disney, with all the parks and theme parks they have, they need to spend a lot on property, plant, and equipment, which basically makes up the majority of maintenance CapEx. So they're not going to have sky-high free cash flow relative to earnings. What I will highlight here is they did take on a fair bit of debt, especially in 2020, when they were in dire need of some cash, and that total debt's far exceeding the cash on the balance sheet. Now, I don't have any problems or any worries or concerns about Disney being able to meet their debt obligations, but when we compare it to, I haven't got EBITDA here, but EBIT, they're over 3 times EBITDA with their total debt now. So that's something I'd like to see them bring down over time. So I'll forecast no debt growth going forward, especially as they start to make some much needed free cash flow going into the next 5 years. They'll be able to pay down that debt, I think, over that period. But then for our terminal values, I've gone with a market multiple and a perpetual growth rate, and then just going to average the two out because they come out with quite different variances. You can see the multiple, which is only 25 times EBIT, which is around where it had been selling for before the pandemic, and not a sky-high multiple for a company growing at the rate that Disney will be doing. That gets us to almost $1 trillion, or 935 billion market cap or enterprise value, in 2025. Perpetual growth method using 3.5%. That gets us to $500 billion, so 532 billion, and we're going to average the two out, and we'll get a $700 billion market cap in 2025 as our target. That's a target price of $389 per share for Disney. Now, if we discount back at the required discount rate, which is 15% for me, we get an intrinsic value, which is unbelievably right on target, or right about where it is now, around $198 per share. We're at $195 per share, so we're few and far between. No margin of safety with this one, so these projections would have to be pretty much spot on for us to be at our required rate of return. Now, I do feel we've left a little bit of upside in this, and I'll show you a scenario in a second that is going to be forecasting some more growth in the direct-to-consumer business, and then also some higher margins as well. So don't get me wrong, there could be some variances in this. It could be better. It also could be worse. Let's not forget that. But going off of this base forecast that we've got here, Disney is just around fair value depending on your discount rate. If you're happy with a 12%, Disney's not the type of company you own because you want really high growth, although it is got a lot of growing segments now. Then based off of that, you've got 17% undervalued stock, and the intrinsic value for Disney is somewhere around $400 billion today, or $231 per share. So keep that in mind. If you're happy with lower than a 15%, maybe a 12%, Disney could be a good buy for you right now. Okay, and we'll flick over to this bull case scenario where I've grown revenue a little bit more. Actually, all the changes that I've made, the only changes that I've made, are in the direct-to-consumer business. So what I've gone with is a higher revenue per subscriber number, because beforehand I was just using the current revenue per subscriber number times by their subscriber targets for 2024, not even 2025. So we're still going to go with the 2024 target of 300 to 350 million subscribers, and I'm going to times it by a revenue per subscriber number of $202 per year, which is $16 per month. So that's 25% growth in only 5 years. So you'd expect that the cost to have all of those Disney Plus benefits, plus Hulu and ESPN Plus, they could get to around $17 per subscriber per month in 5 years' time. I think they'll be able to do it. And then we've also said that the EBIT margin, or operating income margin, can actually reach 25% versus 20%. And when you think of all the intellectual property and content that Disney already owns, they should be able to scale that direct-to-consumer business quite profitably once they start tapering back on spending money on all the brand new content. And that gets us to some slightly higher terminal value numbers. Averaged out, it's $820 billion for Disney in 2025, which is a price target in 2025, not 2030, sorry, that stayed in there, of $457 per share for Disney. And it means the stock would be 15% undervalued. And you could pick it up for $227 per share today and still get a 15% return. So realistically, it's up to you what you think is most likely to happen. If you are that bullish on Disney, and especially the direct-to-consumer business, then this bull case may be for you. If not, then the base case still doesn't look bad as well. You're right on target for a 14-15% return over 5 years, and you'll be part of a very exciting and good brand in Disney. If we roll these into two IRRs so we can estimate the investment return or expected investment return from Disney today, you can see here in our base case that we went over, that's a 15% IRR, 15% compound annual return. So very good return and not too chunky assumptions going into it. The bull case, which has some more bullish assumptions as you would expect, comes out with a 20% expected IRR over 5 years of holding Disney stock, with price targets of $342 per share and $423 per share. So all in all, not a bad distribution of scenarios for Disney stock. Let me know in the comments below what you think of Disney. Are you bullish on their future? Would you be buying Disney at these levels? And how stupid was I to sell Disney? But I'll shed a bit of light on that story in the comments below. Shout out to the patrons as well and Discord members who actually requested Disney. So that's why it got done first. I'm going to try and upload a video every other day for the next couple of weeks and see how I get on with that because I've got a lot of analysis to get out. If you want to join the Patreon and support the channel, you can do so by following the link in the description. You get a lot of free benefits, including the 2 valuation models and the IRR that we've gone through here for Disney and various other companies that we've covered in the future, as well as a lot of other benefits. So just go and check it out, see if you like what is being offered, and you can support the channel whilst doing it as well. So I appreciate that. If you enjoyed the video, leave a like. That helps the video out a lot, helps the channel out a lot as well to reach more people. Subscribe to the channel if you haven't already, and I will see you in the next video. Good luck with all your investments.